Welcome to our Tactical Tuesday for June the 1st, 2021, guys.
June 1st for Alberta. That means the restrictions are lessened today, so very exciting. It also feels like it's it's like 30 degrees out, so it feels like Thailand. So we're wearing like our clothes from Thailand today. Yeah, his elephant linen shirt. But welcome, guys. We've got an awesome guest for you today. Something that we all need, perhaps the most important part of our business if we want to do it smart and set up properly, and that's having an accountant that knows what they're doing. Now, caveat, most accountants know exactly what they're doing. They know exactly, how to deal with taxes and all that, but what they don't know is the specifics that we crazy investors need. I would love to say that we're simple as investors and, oh, don't worry, it's not complicated. But you know what, as investors, it is a little bit complicated. It's a little bit different. And the beauty of George Dube, who we're having on today from BDO, he's not only a CA and a CPA, and focused accountant that he has been for all these years, but he is specifically an investor himself. So if there's, a way to do something,
and deals with a lot of real estate investors, right? Yeah. So like when you're dealing with how many properties in your portfolio and how many in this corporation and how many in that corporation and how do I set this up and what do I do next? And there's a lot of eccentricities that you could say would be a lot different than a typical what you need an accountant for. So it does get more complicated. You need an expert. We've brought you an expert. These are actually the people that we use as well. So we're not just bringing them because, he's a good looking guy and he's super smart.
Dresses well.
We're bringing him because,
got an awesome wife.
Right. Yeah, we're bringing him because he's the guy we use. Simple as that. And we've had a great experience with him.
So a couple things. First off, we are in Edmonton. That's where we live. We're Albertans. George and Peter Coutinho, his partner, they operate out of, is it Kitchener? Cambridge? Well, anyways, out of Ontario.
Kitchener, yeah.
Kitchener. So, people say to us, like, I'm looking for someone in my area. Well, guess what? You don't have to. Everything's done by email anyways. Yeah. We hadn't seen our last accountant that lived in Edmonton and worked out of Edmonton in 3 years. So, we moved over to them a few years ago. They've saved us tons of money. They have great advice. They don't take unnecessary risks, but they do help you to calculate your risks. And that's what I really appreciate about them. So
thanks guys for saying hi as you come on, letting us know where you're from. That's awesome.
Okay, a couple more things. They deal, the best part of, not best part, there's lots of best parts about them, but they deal with small to medium sized guys. They deal with us little fishies. They're not out there with the big corporations.
Well, I'm sure they do that too.
I'm sure they have some of them, but they love dealing with us. They love that personal one-on-one, and their staff is amazing. So one more announcement before we bring George on. We are announcing boot camp. We have dates finally for boot camp. So we are July 9th and 10th. So just over a month from now, we're doing our next boot camp. So guys, if you're looking to scale and if you're looking to really up the ante and get that real estate business going, join us for boot camp. Early bird right now, it's only $27. So it's July 9th for about an hour and a half, July 10th from 11 a.m. Eastern to about 4 or 5 Eastern. So, join us for boot camp, guys.
We'll put the link in.
Yeah, there'll be a link in the feed. $27 early bird. So, yeah, can't really beat it. So, let's bring George on. George, now, easiest way to find him is BDO RE investor.ca. So, obviously, he's focused on investors. Welcome, George.
Thank you. And I agree, Tiffany. Probably the best part about me is my awesome wife. Everything else pales in significance.
Right.
I like the bow ties too, George. The bow ties are
Thank
good.
you. Yeah, a little too warm today.
Yes.
Yeah. Is it nice and warm there right now?
It's pleasant. It's not stifling by any means. It's just kind of a perfect June day in my mind.
Yeah.
Yeah. Awesome. So we have a bunch of questions. Within about I'm going to say 5 minutes of putting a post in our Facebook group, Fearless Investors, and saying, hey, there are questions for an investor focused account. It was like boom, 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 boom. So we want to hit it with you and get as many of these out as we can, and let's just see how many we can get through.
Yeah, and guys, if something is talked about or said and it doesn't make sense, you have some questions, feel free to put it in the feed. We will try to get to as many as we can, and if we can't, we can't. But we'll try to get to as many as we can, and this is why we have a guy like George on, so that you can ask these questions and pick his brain, I guess.
Definitely.
Anything before we get going, George?
No, let's just dive in and see where it goes.
Rapid fire. Okay.
Sounds good.
One of the first questions I see coming in the feed is, where the heck is the bow tie?
Yes, again, it's a little too warm in the. I kind of. It's not that it's permanently retired by any means in June, July, or August, but it doesn't see nearly as much life during that time period.
Makes sense. Absolutely.
Yeah. Okay, so the ever, we've sat on lots of panels with you, George, at different real estate conferences and whatever else, and we always get this question, so I'm sure you're not going to be surprised. But do we buy our properties personally or in a corporation? That's the first part of our question. Let's hit that one first.
Sure. So again, and Corey and Tiffany, you've heard me say this a million times, I'm sure, but it depends. Now, in fairness, I think the majority of the times I'm heavily biased to using corporations. I love using corporations, but it doesn't mean that it's appropriate in all cases. I think at least 80% of the time for somebody that's and I hate to use the terminology because it sounds horrible, I guess, in some ways, but for a serious investor, I think for most situations that corporation is going to be superior for them. Somebody going out and they're buying a $100,000 property, maybe they're ambitious to get one or two in their lifetime. I mean, I say, congratulations, that's better than the majority of Canadians, but the corporation doesn't have enough meat and potatoes there to be useful. But again, I find most the serious investors, even if they may initially be struggling to get those first couple properties, once they get those first two, they realize, oh, if I can do one or two, then I can do three or four. If I can do three or four, et cetera, et cetera. And so that they evolve into that.
So you've talked before about like kind of a dollar threshold at which, point it goes over. And what you're saying is most people will meet and exceed that dollar threshold eventually. So you might as well start out on the right foot. Is that right?
Yes. And not that this is a line in the sand or anything of that nature, but what I've been saying currently, and this, again, it changes over time, but the current number, rightly or wrongly, is to say that if somebody over a 3 to 5 year time period is going to be acquiring, in my mind, $1.5 million of property, and I don't mean equity, property value, then I think a variety of the benefits of the corporation will easily pay for itself, and forgetting the legal, the finance reasons, things of that nature for a corporation, a corporation, in my mind, makes sense. And then to your point as well, far better in my mind to start off that way if we're pretty confident we should be there, so that we don't have a variety of the transfer costs of moving from personal ownership over to the corporation. And not that we don't regularly do that, but it costs more money between the accountants and the lawyers, and again, we're happy to take it. It's not that we're not, but it's really non-value added if we could have avoided it in first.
Right. So from what I'm hearing, just to clarify, it's more a dollar value than it is number of properties. So it's not like, well, I plan to buy 10 properties or I plan to buy 5. There's no number for that. It's more the dollar value of the real estate. Is that what you're saying?
Absolutely. So, I mean, if I buy one property, the CN Tower, that's going to be completely different than 10 little properties in the middle of nowhere, for example. Yeah. And so, and not that there's not other factors. And if I'm, for example, my normal business, I may be earning my income through a corporation already, and give me another reason why I should have the corporation in the first place. And maybe I'm an accountant, a doctor, engineer, consultant, computer person. I've got a corner store, whatever that type of service product offering may be. it pushes us more and more towards that. And another factor that kind of pushes us that way is if we have a discussion with respect to, well, how long are we going to own these properties? Are these properties that are going to, for example, be intergenerational properties? Then it's going to be really, really hard to convince me that we shouldn't have a corporation. Not impossible, but you're not likely to do it.
Yeah,
for sure.
Awesome.
So you kind of already touched on this, so maybe there may not be anything to add to it, but another question was, what is the process or implications of first having it in your personal property and then personal name,
right,
and then ending up having to transfer it? So you said there's extra costs incurred, extra work. Is there any other considerations that anyone would need to think of?
Well, maybe just kind of getting into the theory of it, in the sense that when we transfer that personal property to the corporation, basically we're kind of waving our hands to Revenue Canada to say, hey, here I am, I've just done this transaction, which I'd like you to audit, please. And again, not that we don't regularly do it, but now we're inviting Revenue Canada to take a closer look. And we can do that without incurring any income tax. There may be land transfer tax depending on the province we're dealing with, but we certainly then we file this tax selection to Revenue Canada that again says, hey, here we are. We've just done this transaction which normally tax applies to. We pleasantly decline to pay tax at this time because our net worth has not increased. We're just indirectly owning the property. But again, we filed this document with Revenue Canada so that they're aware that it's happened. It's an invitation. Now, I don't recall, I don't know if I can say this with 100% certainty. I don't recall ever having a problem with one of ours, admittedly, but it's still something that gets attention at the end of the day. And occasionally we do have a couple of questions that come from Revenue Canada, but I don't want to pretend that they're, from a tax perspective, rocket science. But part of the problem, again, is to your point earlier, yes, there's extra costs because now the lawyer is going to have the costs associated with just doing the transfer itself. There's an agreement that really should be created to coincide with the tax election, and then there's the tax election itself, and that's just money out of the investor's pocket. Again, far better than, in most cases, than the alternative of keeping it personal, but it was a cost we could have avoided, or series of costs.
Yeah, awesome. So, and does it matter if it's passive income that you plan on, creating, or if it's active income that you plan on? Does it matter at all, or no?
It can. I'll just change the terminology slightly if I can, and instead of active or passive, which there can be kind of some different definitions of, what we're not able to do, for example, is to transfer a property which in Revenue Canada's eyes is inventory. In other words, we're intending on selling it, which would be in one of the elements of active, but just not all of them, why I'm hesitating to use the active versus the passive. So if we're intending on selling that property, we're not eligible for the tax election. And if we end up selling it within 3 years, there's some other rules in the Income Tax Act that can basically allow Revenue Canada to say, hey, wait a minute, we don't really like what you've done here. We're going to pretend it never happened, or we're going to pretend that you actually sold it for fair market value. So again, some cautions, but in general, for somebody, again, that's intending on holding that property for quite a long time, then absolutely, again, we regularly do it, just it was a cost we could have avoided.
Right.
Yeah.
In some cases.
Yeah. And, we're always looking for ways to save, like 2 ways to make money in business: increase profit or decrease your costs, right?
And that's one of the things that I'm hearing over and over again already is it's better to sit down or speak with an investor focused accountant like yourself, George, prior to getting yourself set up, prior to buying some properties, to just get an overview of what our personal situation might be like, because obviously everybody's is different, and what we should do. Should we set up a corporation? Should we not? Just like to have that conversation before we go and start buying stuff is going to get us a lot farther ahead than after the fact.
It is. I mean, to me, you're paying for advice. People can pay to have tax returns done, bookkeeping, financial statements, and I'm not trying to say that that's not important. It is, but far more important in my mind is actually doing a little bit of planning. And it doesn't mean we need to be planning every week or every 3 months by any means, but just kind of following a game plan. And as situations change, evolve, rules change, making sure there's periodic updates to that. And it doesn't need to be a finely typed, beautiful business plan by any means. It can be a one pager with some bullet points to it. But then I think too, it gives a lot more confidence for the investor to know, yeah, everything's going along the way it's supposed to be. And if they're involving not just, this isn't just applicable from a tax perspective, but the legal and other advisors as well, for that matter, coaches and whatnot. Get those people involved so that they can provide some input. You as the investor are ultimately making final decisions, but weigh some of the advice from the people, and absolutely you have every right to ignore it. Just weigh it.
Yeah, it doesn't hurt to get that advice from professionals that are dealing with this stuff all the time. And I will just say from personal experience for all of those listening, a few years ago, we dealt with a situation where we were selling a company. And so what did we do? We contacted George.
Could have been Peter too.
we talked with George and said, here's our situation. This is what we're wanting to do. Give us some advice. Well, how would you structure this? And it was extremely helpful. So having that hour-long conversation changed our outlook and our plan as to how we were going about to do it so much. So,
and I want to be clear, that wasn't, that we are clients of George's. So, we don't call him up on his personal home phone number and say, hey, can we get some advice? This is a business transaction that we, book in and get a consult and we pay for it. We're happy to do that because I don't even know what it was, like a couple $100 that we paid for that time and that advice, we were able to, maneuver and strategize so that we saved tens of thousands of dollars probably in taxes just on that one transaction. So guys, it's worth it. It's not, we can't expect people to work for free, but is it worth it? Like 100 times over. I have one more question for you on the whole corporate personal thing. So we've dealt with Karen's, Ching's, Maureen's questions, and this is Earshot's. He says, is there any benefits or what are they for holding multiple properties under one name versus having them under different, holdcos or corporations or whatever it might be? Is there any benefits to splitting them up versus keeping them together?
Pros and cons, and we certainly see both. And ignoring, obviously, not that we're lawyers, but obviously, I think a lot of lawyers like to see a little bit more segregation for liability reasons. But from an income tax perspective, generally speaking, if I've got a variety of properties where I've got the same exit strategy and same idea or strategy with the property itself, and I'm dealing with the same province, then whether I've got one corporation or 100 corporations, my taxes calculated were going to be identical as a general comment.
Okay.
Where I like to see those extra companies, though, is I may have some properties I'm flipping, some that I'm doing the BRRRR strategy with, some that I'm doing co-venture relationships with different parties. And I've already mentioned the different provinces. So when I can, if there's enough meat and potatoes, I would like to have my Alberta properties in Corporation Alberta, my BC and BC, my Nova Scotia, whatever I'm playing with, so that I have less of a chance of getting in the middle of a fight between two provincial governments who can spend money far greater than my capacity to do it. So I'll lose before I started. So why get into a fight that I don't need to?
Wow. And you know what, George, you didn't even realize that, but you just answered one of the questions that came up about what type of corporation is best if I want to invest across Canada. So, without even knowing it, you answered. So,
one other question that came up that we was a little while back comes to like fees for if I'm taking a course to do with real estate investment, or I'm getting coaching, or I'm paying money to
join Ignited.
to join or to educate myself in the real estate investment world.
Where there is also a network and a membership and a networking component to that. Can I write them off?
Yeah.
Yeah. So again, in my mind, Almost always, yes. Where I have the caveat there in particular. So if I can go a little bit backwards, so kind of the rule in the Income Tax Act is something to the effect of, thou shalt deduct whatever you feel like it, provided it was for the purpose of earning income from a business or a property. And so the catch is, from an auditor's perspective, they would frequently attack these types of costs to say, well, we don't think you needed it for the purpose of earning income. You could have just called a realtor and you could have been in business and you didn't have to incur all of these extra costs. And so part of the nuance with going back to the corporation versus personal, again, in theory, the Income Tax Act applies in most cases equally to a personal versus corporate. But now the interpretation is slightly different. And so if I am as an individual trying to deduct those costs, it's a very different argument as compared to a corporation. And the nuance there is that in a corporation, it's a prima facie case to be made always that it was already in business because there's a corp just by definition. Whereas an individual, we start to get into the arguments. Again, I stand to be corrected. I don't think that if I've had the argument, I don't remember it in the last 25 years dealing with a corporation. An individual, we frequently get audited, or our clients get audited on those. And there's different ways of positioning that. But in the vast majority of cases, I think it should be deducted. I've always deducted 100% of mine, no question. And I, to my knowledge, I've never seen it fail through a corporation.
Okay.
Awesome.
And we always deduct ours as well, but it's a good question and one that merits asking. So just a real quick one on having corporations. If you live in one province but are investing in another, you would open a corporation in that province that you are investing in, correct?
It doesn't have to be. I defer to the lawyers, but we'll see frequently the provincial companies, just as kind of indicated, but at times as well, we'll see the federal companies created. From an income tax perspective, it really makes very little difference. I get a little bit more excited about how things are done if I'm dealing with Quebec issues, but if I'm dealing with the other provinces and territories, I'm largely indifferent.
Okay. Awesome. And Greg, just so you know, when we head over with George to the laser session after this is over, we'll be dealing with Bear Trusts over there. So I'll just keep that for then, just because it is a little bit more complicated and maybe not as relevant to everyone watching as some of these other questions. So, but we will hit it in laser session. You can talk one-on-one with George. So, okay, so that's awesome. So that's kind of the corporate stuff overview, personal versus corporations. Let's talk about depreciation. And we had a number of different questions of people asking about, do I depreciate? What's the difference between depreciation and CCA? And how do I depreciate? Should I depreciate my assets? So let's talk about that for a minute.
Sure. So depreciation as compared to capital cost allowance, sorry, I can't spit it out, or CCA. One is for accounting purposes, depreciation is just kind of a general terminology, and amortization is another one that kind of gets looped in there. Whereas the CCA is basically Revenue Canada's definition of what a reasonable rate of amortization or depreciation will be from a tax perspective on the asset. So from an income tax perspective, we really only care about CCA. The depreciation is just whatever shows up in our financial statements, period. In terms of should we take the CCA, in the vast majority of cases, I love taking CCA. To me, it's basically a way of getting an interest-free loan from the government. In other words, I can, with that CCA, decrease my profit. So now I've paid less income tax. And the basic agreement with Revenue Canada then is if I sell that property and hopefully I've made a profit onto it, I have to pay back effectively those taxes that I've claimed over the years. So I may not sell that property for 20 years, or it might be sold by my great grandchildren. And so depending what I do with that property, that could be a pretty inexpensive loan to get from the government, so I'm all for it. Where we hesitate, for a couple different examples. One is if we have or may be using a property as a personal use property, where our family is, or a cottage type of property, then we don't want to claim the CCA in most cases. And in some cases, we're also managing tax brackets. So if I've got virtually zero income and I want to show some income, then I may not take CCA.
Makes sense.
Yeah, for sure. Okay, so that's awesome. Does it change when sorry, okay, wrong question. I'm like, wait a second. Does it change whether that's something like as simple as, furniture or computer or appliances, like something, let's say a couple $1,000 versus like, a property? Would your answer change based on that or no?
The appliances, computer equipment, things of that nature, they're not subject to the exact same rules or negativity if I have a personal use property. More the practical thing with some of those costs, and not that Revenue Canada would technically agree with this by any means, but there gets to be a point where how much of this stuff do you really want to keep track of? So in other words, if you bought a $600 asset, are you really wanting to track that puppy for the next 20 years? Probably not. And I have no idea what the number a General Motors, for example, or Royal Bank of Canada would use, but I'm pretty confident they don't they don't capitalize a $600 asset. It's going to be presumably at least six figures, if not 7 or 8, before they even get excited about that type of transaction. So it's kind of trying to find what's a reasonable number to do that. And when push comes to shove, no doubt Revenue Canada would win that argument in the sense of, George, you shouldn't have depreciated that asset you should have depreciated the asset. You shouldn't have just written it off. And so maybe I'm going to be out a few bucks, but if I'm consistently doing that, it's just not worth the extra aggravation. But somewhere there's got to be a practical number there. And I think too, we try and feed Revenue Canada a bone to say, hey, when we're starting off, we'll have some furniture and stuff, but replacing it, I don't get too excited.
Right. Yeah, I really like that. Like, do you really want to be cracking this asset for the next 20 years? And that's a really good, kind of baseline question to just ask yourself when you're making that decision without having to check in on every single item.
So before we move on to the next question, I just wanted to say for everybody watching, maybe you feel a little bit like me, and we're having this conversation and we're listening to George and we're getting these awesome answers and he's clarifying all this stuff, but we're hearing CCA and depreciation and we're hearing all of these words and we're going, I don't know if I'm going to remember all of this, and this is too much information for me, and it sounds really complicated. Here's the thing. We don't need to know the answers to all of these questions to be doing what we're doing as real estate investors.
We could have answered these questions for you if that were the case. If we knew it all, we would just have a Q&A show on us answering accounting questions.
Exactly. Very, very good point here, guys, is you don't need to know the answers to all these questions. What you do need to have is a guy like George on your team. Yeah. So a guy like George that you can call up and say, here's my situation and this is what I want to do. What do I do? And he's going to give you those answers. Or at the end of the year, when you're doing your books and they're clarifying everything, you have somebody that understands what we do as real estate investors. So I just want to make that clear, everybody, because sometimes we get a little overwhelmed when we're going through all of these questions and how I should do this and what I should do here. And everybody's situation is slightly different. So I just wanted to clarify that. Make sure you have an expert on your team, but you yourself do not have to be the expert.
Yeah, so it's the who, not the how, right? As Russell Brunson would say. And interestingly, George's team is also awesome. Truthfully, we actually don't even deal with George. I don't know if Mike told you this, George, but this at the end of our year end this year, he's like, okay, so I think that we've got everything all figured out and stuff. We had a meeting with him, and he's like, so would you like me to, check in with George and then come back to you guys? And Corey and I are both like, no, we're good. Like, we know you did awesome stuff. We've dealt with you for so long. And he's like, I love that. We're like,
That's a key point too, though, is just to say I don't need to be involved with every little thing that's going on. I've got a great team, and they're also capable where they know they've gotten in over their heads to say, okay, George, we need you now, or there's something coming up, George, you need to jump in here. But often, in fairness, I do work behind the scenes in many cases, just in trying to help as many people as possible. It also means I let my team help out in those situations where, in some cases, they're better than I am. For example, in terms of pure bookkeeping type of questions and things of that nature, my knowledge now, not that I'm completely incapable of it, but I've certainly got people that are much better at it than I am, and in different areas. And Mike's one of our senior managers. He's fantastic, and he's going to be better at certain things than I am.
Yeah.
Great, let him do his thing.
And that goes throughout this whole business of real estate investment, and really any business that anybody's going to have. It's not about knowing everything. It's about having the people around you that do know. And so that's why we're bringing on somebody like you, George, because you're the person we rely on for these types of answers. So
okay, so this question, I'm just going to kind of paraphrase it for you. The idea is, if the mortgage and title are both in both the husband's and wife's name, do they have to income split 50-50? Or what's the rule there?
It's not that they're required to, although typically, and it's really hard to get around this, once you've set your split, that's going to be maintained now for evermore. Okay. But Revenue Canada, in theory, if I can give a more dramatic example for this, if we've got one of the spouses, they've been making $1 gazillion every year. The other spouse has been making nothing for the last 20 years, no inheritances, no lottery winnings, etc. It's going to be pretty hard to argue with Revenue Canada that things should be split 50-50. So Revenue Canada wants to know kind of, hey, where'd the money come from? Now, you don't have to measure it to the nth degree by any means. There's a fair bit of latitude there. Frequently, it's a 50-50 split. For spouses, because it's also can be a bit of a challenge, particularly around Christmas dinner. Honey, I love you, I trust you, and I'm willing to give you 49%. That can be an awkward conversation.
Yeah.
But consistently holding on to that. So there are some realistic parameters, but again, they're particularly on the personal side, relatively speaking, flexible. If there's some remote amount of reasonableness there. The bigger thing in my mind is, again, going back to the corporations, I can still, with a corporation, in most cases, own something effectively 50-50 with a spouse. And that is going to be a completely independent decision in terms of how the revenue gets divided. Whereas if I personally own those properties, if I own half of it, I'm going to absorb half the income, half the losses. I mean, there's a couple of minor exceptions to what I'm describing, but generally, I'm kind of locked in. And Revenue Canada, between spouses, does not like to see changes. Whereas if I make changes with a parent, a child, sibling, arm's length investor, relatively easy to do. Between spouses, it can get more attention.
Interesting. Awesome. Okay. This again, I will just kind of paraphrase this. I have an active income property. I added one into a corporation that was meant to hold passive income. So as long as I keep my transactions super clear, is that okay?
Yeah, so while it may not be ideal, it's certainly not something I would panic about in most cases. The tax return is certainly designed, and the tax system certainly designed to have both passive and active income within the same entity. So that in and of itself is not a problem. It's probably more of there's some tax strategies that can be thwarted by doing that. But as a general comment, it's not an issue. We'll have a significant number of clients that have a mix. So again, it's not like it's unheard of by any means. Whether you want that or not, it's a separate matter. But in and of itself, yes, the tax calculation, again, if I had 2 corporations versus 1 corporation, same story as before, forgetting different little province things and whatnot, the tax calculation is going to be identical one way or the other, whether I had 2 or 1 company. It's other strategies that might get impacted as a result. And, and technically, there's a couple of other side splits there, I could say, in terms of rules, but I'm sure we don't want to get into those.
Yeah, generalities are probably good for this, but if they do figure that they might need some of those, then they can definitely contact you, I'm sure, and
Definitely
clarify. So, okay, so what about deferring capital gains as long as we are selling one property within 12 months, buying another one? Can we do that in Canada?
Yeah, so just as you're implying, I mean, that's, we frequently get the question. I'm not a U.S. tax expert in the slightest, but in the United States, they do have, I believe it's called a 1031 exchange, where to a degree that's allowed to be done. In other words, defer that tax. In Canada, the shortest answer is no, you can't do that. Technically, there's a couple of cases where it can be done, but again, that's not very frequent, and more where, and I hesitate to jump into it because it could lead off to a variety of questions, but the vast majority of times it's not possible, but admittedly there's a couple of scenarios where it is possible.
Okay, interesting. I would have said a hard no on that one. So see, that's again why we need a proper.
There's always exceptions.
It sounded like a pretty hard
good
no, but not quite. Yeah.
Yeah, exceptions are good. Okay, so if we have, okay, I'm going to just read this one. When I set up a joint venture partnership with one partner owning the property and holding the mortgage personally, and the other partner's not on title at all, can the income and ultimately the capital gains be split in any way you want? And is the JV agreement enough for CRA to accept that split, whatever way it's written?
Generally, yes. Making certain assumptions, and one of those primary assumptions is, again, if we're dealing with arm's length parties and you've come to an agreement, it would have to be pretty drastic for Revenue Canada to override your agreement. Things that they're looking for, though, is a real agreement, ideally done prior to transactions being carried out or shortly thereafter, as compared to 10 years after the fact. And they're also going to be looking at tax returns. So, for example, if we're saying that there's a 50-50 joint venture, have you been claiming 50% of the income in that intermediate period of time? Or have you been using different percentages? So we certainly seen some cases where people would try to do their definition of tax planning where they'd say, hey, why don't you absorb this income because you're in a lower tax bracket? Well, Revenue Canada is going to jump all over that if they look into that type of a scenario. But if you've been consistently filing on whatever your split is or agreement is, pretty hard, again, where it's arm's length for Revenue Canada to disagree with that.
Okay, awesome. Nice. Yeah, great. So if you're flipping only like 1 or 2 a year, should you do it in your personal name or should it be a corporation?
Again, just from a pure income tax perspective. Now, again, let's talk about the scope. So if the expected profit's going to be $500, then by all means do it personal from an income tax perspective. Whereas if we're intending on making a decent chunk of money, it won't take very long before, and again, it depends on a variety of factors, but somebody kind of in an average or an above average personal tax bracket, if they're able to do that flipping inside of a corporation, depending which province we're talking about and a variety of other assumptions, kind of our worst case scenario is we're going to be in the high 20% range for income taxes, and it's quite possible we're a lot closer to 10% in the corporation. So, well, if I'm paying 40 to 50% on the personal side, it doesn't take a lot of profit before that differential in tax rates is going to easily pay for the extra costs of a company sitting around.
Awesome answer.
Yeah, super good. super clear. Okay, so here's a question about losses. So there's a question between like if I have a loss in a company versus, this is how I've kind of deduced the question is, can you write off losses in a company but not personally? Or are we never able to write off our losses? And how do we best deal with those? And that's from.
Yeah, I'm not sure if I'm going to answer this the way it's intended, but let me give it a shot. So losses within a corporation cannot be deducted on the personal side, but they can certainly be deducted at the corporate side and carried forward 20 years. So if I have a loss in year 1, maybe it won't be until year 3 where I have some profits I can set that loss against. So those losses don't just disappear. And if I don't use those losses in 20 years, I would suggest I've got bigger problems. So yes, we can use the losses, but I can't directly use those losses on the personal side. That being said, maybe there's opportunities for me to shift personal income to the corporation or from other corporations to my loss corporation in order to take more immediate benefit of those losses. So there's other planning that's involved as well. So okay. I'm not sure if that was the direction they were heading with the question.
Well, this is one that I sent to you ahead that was more detailed, so you probably have a good idea of it, even though my question wasn't as thorough. So Travis, George did get your question ahead of time, so he's got a good handle on what you were looking for, I think. So, okay, so interesting. Oh, okay, sure.
Good question here. What are some strategies to reduce the capital tax gain after selling a rental property? Is there anything?
Or are there any?
Or yeah, is there anything?
We're limited, admittedly. There are some strategies, and for example, I can use a vendor take back, and effectively, I can stretch out the amount of time until I have to pay all the taxes. Doesn't mean I don't have to pay any of them, but I may stretch that out potentially over 5 years, for example. But there's good and bad with that, right? So I mean, from a business investment perspective, I love my cash now. I don't really want to wait for it in most cases. So, and am I really going to be that much further ahead of the game from a tax perspective? So if I'm using a corporation, I'm probably, not necessarily, going to be in the same tax bracket one way or the other. Yes, the tax brackets change slightly over the years, but really they tend to be insignificant. Whereas on the personal side, there's a huge difference going from a low to a medium to a higher tax bracket. And so yes, it can make a lot more sense there, but it can also be a disadvantage. So we'll see some cases, for example, where somebody may be collecting old age security, different pensions. And some of those are income-based, are tested so that if they have too much income, they have to pay back those government benefits. So now all of a sudden, if I stretched out my 5 years and I lost benefits for 5 years as compared to just take my licking and do it all at once, again, so at times there's playing around to see whether it makes sense or not. Far more frequently, I would suggest instead of really worried about the capital gain part, could I've avoided the capital gain in the first place? And that sounds silly, but just a classic example, a lot of people are looking to sell a property because they want to go and buy a larger property or more property, for example. Well, on an after-tax basis, would I have been better refinancing the property? Maybe I don't get quite as much as I want from a leverage perspective, but when I consider the transactional costs and the taxes associated with that, now I've got, in a simplistic example, 2 properties instead of 1 property. Maybe for that first year, I wasn't quite as better off, but if I allow myself to do a calculation over 2, 3, 5 years, now I've got 2 properties where I've got appreciation, cash flow from rent, etc. Somebody paying my mortgage, almost always going to be better off. So again, should I sell it? Or if I need to move properties around, can I do it on a tax deferred basis? Can I transfer a property to another entity without triggering immediate tax? And maybe I'm going intergenerational, for example. There's ways of doing that without triggering tax right away. And being able to time things. So a lot of it isn't so much kind of, in my mind, planning for the capital gain itself. It's trying to plan for how do I avoid the capital gain in the first place.
Beautiful. Awesome. Okay, Gabriella, so that was the first answer to your question. The second part of your question, I wasn't able to quite get it clarified. So, and then Sam, you asked this question about AFS. So George is going to join us in laser session right after. So we'll hit that question then, just so you know. Okay, Jay's question we got. Okay, Bear Trust, I don't think we really have time to go into, or we might actually. Okay, let me hit this other one. If I buy a property, I do a major reno, and then I rent it out the next calendar year only, would I be able to deduct soft costs and declare a loss during the year when the renos are being done? Or is the only way to capitalize soft costs in such a case? Or is there a way, I think is what you meant.
Yeah, it seems like we're mixing a couple questions there, but I guess maybe how I'll tackle that is to say, when we're going through a renovation project, Revenue Canada's got a set of rules that basically say, and I'm assuming they've talked to somebody, because very few people know the terminology soft costs and actually use it in the correct correct context. So, so these types of soft costs, it can be interest expense, property taxes, blah blah. There's a handful of different things that are associated with kind of getting a property ready, if you will. So Revenue Canada has the ability to use a particular rule where if the property is under renovation, we are potentially having to capitalize those soft costs, and now they're part of the cost of the building, for example, that get depreciated over time. There's got to be a practical element to it, though, because I mean, properties are almost always having some repairs done to them. And clearly, if somebody's just kind of repainting a unit, no problem. We probably tend to see people get into a little bit of trouble occasionally, in particular from getting ready to sell a property. I have a tenant that's left, and now I've got it vacant for 3 or 4 months. I don't want to put a new tenant in there, perhaps to accommodate the buyer, and I use this as an opportunity to renovate that unit. Potentially I'm going to have to capitalize some of those costs. But we also go to the kind of the magnitude, how much is it involved? So it's definitely more of an art than a science, but from a pure technical perspective, unquestionably Revenue Canada has an ability when there's renovations to capitalize a lot more than we'd otherwise like to see them. It's not frequently brought into play, but where I've had audit issues, I guess, is the perhaps of more interest to many people, is in particular when we're getting ready to sell a property, or it's just been a kind of an extended period of time. And one real quick hint, if I can, to help combat that, is if I can, in many cases, show that I was attempting to rent it out, and I can show them some of my advertising, then that goes a long way to helping alleviate some of those concerns.
Awesome.
So
All
don't
right.
throw away your advertising, as odd as it may sound.
Yeah, well, I mean, yeah, with CRA, a lot of it is just what's your intent, right?
Yes.
A lot of it. So, like, can you prove what you were trying to do? So, yeah. So there you go, Elena. There's your answer to that one. Thank you, George. So we do have a little bit of time. So one question, and we'll get this now. It's up here, but Lori says, "I'd like a real estate focused accountant in Ontario." So, yeah. Hey, so how do they get a hold of you best? We have your website up here on the banner, as you can see.
Most people will find it probably the easiest thing is reach out via emails. Dube, Gdube at bdo.ca. And admittedly, I'm frequently behind an email and things of that nature, but the nice thing is I've got 2 lovely assistants that help out with that and often kind of jump in on those types of emails that aren't very technical from a tax perspective, so that they're kind of, yes, they're sent to me, but admittedly my team usually handles those unless there's something a little bit more complex or gets things started for everybody. That way I don't slow it down.
Perfect. Okay, awesome. So we do have a few more minutes here. So can we get into bare trusts?
Sure.
Yeah, awesome. So what is a bare trust?
So a bare trust can be thought of, in my mind, as an agreement or an arrangement where I'm probably segregating legal ownership and beneficial ownership. So the classic example from a real estate context is typically I want to qualify for financing, for example, using my personal name. It's easier in some cases. And so legal ownership of the property may be in my personal name, but beneficial ownership, meaning who's got the rights and rewards of ownership, belongs to either a corporation or alternatively a classic joint venture where it may be split between two different parties or two different families. And again, who's on title may not be representative of who actually has rights and rewards of ownership. So that bare trust agreement is going to define, it may say something to the effect of, in a very simplistic way, George is holding this property legally, but he's not making any decisions with it. All the decisions are being made by George's corporation. Or that'd be the more typical bare trust agreement as compared to the joint venture, but there's a lot of crisscross, if you will.
Yeah, awesome. So, so does this work in a JV? You just answered that question, which is great. And there's a question from Greg that I wanted to grab. Let me see if I can find it up here. No, sorry.
You passed it. You passed it again.
Again? I want to make sure to hit Greg's question.
Okay.
Oh, there. I just saw it. Good. There. Yeah. Okay. I have a property bought in my personal name. You can put it up there. But in a bare trust with my corporation, is there a way to refinance it into my corporation without paying the land transfer?
Yeah, so making a quick couple of assumptions there. If that property is, and it can be proven, is beneficially owned by the corporation through this bare trust, then there's no problem with refinancing it. All of that should already be in the corporation. There's no, not that I'm a lawyer, but to my understanding, there's no requirement to transfer property or anything. At some point, you may, I think the Ontario terminology, and I stand to be corrected, is to convey that property to the corporation. But again, it's not a transfer from an income tax perspective. That's changing legal ownership, not beneficial ownership. So as I understand it, again, to be confirmed by legal advisors, of course, but I don't think I've seen a client pay land transfer tax on such a transaction.
Interesting.
Yeah, really, okay. For sure. So,
makes sense.
So with bare trusts, would it make any sense to use that in succession planning, like putting, beneficial interest in your kids' names and that sort of thing, or is that just a totally other whole?
I think it's something else where to me, there's better strategies involving the kids, next generation, things of that nature. The bare trust agreement to me is kind of more done where, and there's a couple of different formats, but in a more complex environment, I've got a general partner, limited partnership structure. And for legal reasons, not tax reasons, my limited partnership's not allowed to own the property. So I might have a nominee corporation or a general partner own title and on behalf of the limited partnership. The 99% of the transactions we see, though, is somebody trying to qualify for financing. And they've got their personal name onto it, and they're taking the risk from a mortgage perspective that the bank won't care. And some cases they legitimately don't care, that it's fully disclosed. Other times, I would suggest there's some risk there. But again, something probably better discussed with the legal team and the mortgage broker side.
Yeah, makes sense. Okay. So Smith maneuver, whole other topic, obviously. But quickly, would it make you're a go for that?
I personally use it. I've used it a few different times, admittedly, in my own situation. Many of my clients use it. Yes, I'm a big fan of it.
Nice. Awesome. And just quickly to ask that question, then, would it make sense to move properties from a holdco into someone's personal name to take advantage of that Smith maneuver and the cash damming part of it?
In my opinion, almost never. Instead, I would suggest there's other ways of using the Smith maneuver, so it doesn't need to be personally owned real estate. In my situation, I do not own my properties personally. They're owned through corporations. I can still do a Smith maneuver, but it's not done in the same way. There's multiple ways of doing a Smith maneuver, but I can do that maybe not as fast, but I can still do that with a corporation, and I'm doing it today. So the problem with kind of starting to move properties to personal names is now particularly if it's a longer term hold, there's a whole lot of other consequences to that. And if nothing else, if I started in a corporation and took it out to the corporation, ouch, I've sold it in the business. Now I've got this personal asset. I'm paying presumably a whack of taxes on that. And I'm also setting myself up, if I wanted to pass the assets or replacement assets to the next generation, I've probably thrown away 25% of my net worth doing that. So
wow.
That's a big number over time.
Yeah, no kidding. Okay, Darcy, so there's your answer. That's awesome. And those, that are looking for Smith maneuver stuff, then George is your guy. So Corey we're having a bit of a power issue, so he just ran to bring an extension cord. But thanks, George.
You're welcome.
Fire, your brain is probably exploding. I think you need to go have a scotch very soon. But thanks for joining us. We're going to jump into Ignited yet, but let's give it a few minutes here. And thanks for always being willing to help and think those outside of the box. And thanks for knowing everything so that we don't have to.
It's a pleasure chatting with you always and your group. So it's a lot of fun, and it forces me to stay on my toes as well, if nothing else.
It's true, like that rapid fire panel stuff. So everyone's saying thanks, lots of love for you. So I will just really quickly before we sign off, guys, reminder about boot camp. Boot camp is coming back, so we've got dates for it, July 9th and 10th. Early bird's only $27. It's craziness. Replays will be up for 2 weeks. It's an hour and a half on the Friday night, and then it'll be a full day Saturday. And there will be an opportunity to get the scholarship into Ignited, so into our mentorship program. Every boot camp we give one away. So if you guys are wanting to scale your business, join us for boot camp. So there we go. Power's all good.
Yeah.
Perfect. Thanks again, George.
Thank you. Pleasure.
Okay.
Thanks, bud.
Bye now.
Have a good week, everyone.